So the first question I have here, which was from Wanda, was that sometimes the retracements, if using the fib, it looks to retrace even up to 100%. Is that retracement still valid, or the trend has changed once we retrace to full 100%? Okay, so I actually have an example of this. So let me just clear this chart up over here. And if we look at the 15-minute chart over here, and we pull a fibs from our break in structure, and we zoom in here to the level that we saw. So here we are pulling out fibs from the bearish order block over here, and we can see that price wicks through sometimes. This is just an example, obviously. So I'm not telling you how to pull fibs or whatever the case is. I'm just using this as an example for this question. So Kawanda's question was, if price trades and goes above the 100% level of the fibs, so the question is, if price goes above the 100%, is it invalid? Meaning that will price not then fall down or go up? The answer to that question is, if price wicks through but still closes below, then it is valid because price will wick. But as long as we see bodies closing in our levels, our sweet spot levels, if we see bodies closing and there's just wicks, only wicks going through, then the setup can still be valid. And the same can be said if we were looking and we had pulled a bullish fib. So if we see wicks going through, so even if this wick was right up there like that, and the bodies of the candle still closed inside of our sweet spot area here, then the trade can still be valid. Okay, but if you had a sell limit set and you had a stop loss set, well, then you would have been taken out the trade. So I see, I think it is Ravi, he loves to trade only with fibs. So fibs is only one confirmation. You need to use other confirmations to also take your trades. So once price closes inside of our sweet spot and we are looking to sell, then that is still a valid entry. Obviously, the higher the time frame, the better the opportunity. So there's probably going to be a few questions based on how and why that we pull fibs the way we do. And based on that, well, it's pretty simple. So if we look at the 4-hour chart and we pull our fibs from the recent high of the bodies to the recent low of the bodies for a sell, because we see price going down, and when price comes back into our sweet spot area, we use it as additional confirmation to sell. So here was a fair value gap over there, and we can see that that fair value gap was filled. Plus, we also have a confirmation that this is a 62% retracement into our area where we want to sell, because this is premium and we like to sell at premium. And the same can be said in a bullish scenario. So if we look at the bullish scenario over here, recent low to recent high of the bodies, we can see that price exactly trades into our sweet spot zone, which is our 79%. So like Wanda asked, well, what happens if price goes past the 100%? Well, that still makes this a valid setup, but obviously if you had limits, buy limits set here, you may have been stopped out, but you can see that the candle bodies are still closing within our discount range. sometimes price will wick through because there is possibly a reason as to why it's doing that. Maybe there's a point of liquidity. So in this particular example, like I said in the previous video, that there's obviously stops, sell stops and buy stop losses sitting here, and price wicked in there, taking liquidity and then running up. Okay, so that is the reason why we are pulling fibs, because we are looking for a discount in price. We don't buy at market price, we buy at discount price, or we sell at premium price. Okay, so hopefully that answers his question. Anyone else, if you want to ask a question? Benson, you've raised your hand.
Yeah, thank you, Darren. Good evening.
I can hear you. I'm doing good. Go ahead.
Okay. So actually, my question is on GU. Can we get to GU the moment? Okay, that's correct. That's correct. So, um, what I wanted to ask is, I don't know how to put this. I don't know how to put it. Okay, okay. When you look at the FVG down on GU, let's get to H4. Okay. Okay. When you look at the possible FVG down and the one up, I mean, is there a possibility that the market makers we have a preference of the FVG they want to feel before another? For instance, this is a confirmed downtrend, and is there possibility that they want to wait the FVG up before coming down, or them going down to the one down before going up? I mean, is there a possibility of them having a preference actually?
So
Thank you.
you need to, yeah, so to answer your question, I think you're talking about this FVG over here on
Yeah,
GU.
that's correct.
So this GU
And
fair,
the one down.
yeah, and the one down. So these are obviously recent um, price rallies that created these gaps over here. Okay, so you need to think of it as a perspective from a market maker. So the points of liquidity for a market maker are obviously these points of liquidity sitting over here. So there is more liquidity where price is currently trading at, and it is easier for price to go up, okay, and then go down than it is for price to go down and then to go up. Now, I'm not saying that they won't go down and then up. I am saying that when there is liquidity, what will happen is they engineer the liquidity using the resources available to them. So you can imagine they obviously have a ton of money. So what we can see here is they might not even come here and then straight from that point go down again, creating another pool of liquidity sitting over here. So often there will be times where we have what we call equal highs or equal lows. And then they will only be rated at that point. So I'm just looking here if I can find a recent example of that equal high, equal low scenario. Um, well, we can basically see it over here where there was liquidity sitting over here and price wick in there, taking out the liquidity sitting over here, then price rally to the downside. So if they are wanting to continue a bearish direction, we can see liquidity, a drawn liquidity. So these highs being taken and then a move to the downside over here. So that is a likely scenario that we could see if price was to continue downwards, like right down all the way. If we look on the daily chart, like go back into our daily order block. But obviously this is a daily order block, and price has just broken this daily order block sitting over here. Okay, so price currently, as we can see on the daily chart, is very bullish. Okay, so to continue that momentum is easier for them to go up than it is to go down. Okay, so they likely will close the fair value gap, take out these points of liquidity over here. So once these points of liquidity have been taken, we can expect to see some sort of price reaction at this level over here, which is our institutional price level of 200 at this level. And obviously there is a 4-hour order block sitting over here. So there is obviously a reason to look for sells at this area. But keep in mind also that this is also a point of liquidity. So because it is a point of liquidity, we can expect that price can wick above. And also we have an institutional round number over here of 1.27. So if price continues and we don't get the reaction like we like to see, once this gap is closed, it is likely they will raid this high over here, and then we will see a move to the downside once that liquidity has raided. But if we look on the daily chart, I did say that there was a fair value gap over here, but it is such a small fair value gap that it is likely that even though it is small, they might still tap into that. And you can see that based on what I drew here on the 4-hour, that scenario plays into this daily fair value gap sitting above here. So there is lots of liquidity to be raided if they do a move to the side. And once they raid liquidity above these recent highs, we could expect a drop in price, because the reason being is that a fair value gap gets created when there's a large move to the downside. So a liquidity void or a fair value gap gets created because there's huge selling pressure. So when this large black candle, bearish candle was created, this created a liquidity void or fair value gap. And you can see these wicked into that fair value gaps or liquidity void, and then price continued down. So when a liquidity void and a fair value gap is created, we can expect a large grouping of bearish or sell orders placed at those levels. And when price gets back to those levels, we can expect a rally in price. Because if you look as an example over here, so this is a liquidity void on the 1-hour. Sorry, this is a daily. So price rallied up here. And when it came back to that area, we can see price again rallied up because there is a large grouping of buy or bullish orders sitting here. So when price comes back into a large liquidity void, we can expect a move again to the upside like we did here. So the same can be said if price wants to come back into this closing of this daily fair value gap sitting over here, we can see a move to the downside. Now, there's no telling how large that move to the downside will be, but if it does, we can expect a large move to the downside because we can see how large this move to the downside was when this liquidity void was created. So we could even see a further breakdown in market structure if price was to go above that level and take out these points or these recent highs above these areas and raid above. So that, I hope, answers your question. I know it's a long answer, but that's the easiest and best way I can explain it for you. Benson?
Yeah, thank you. Thank you. That's very much explanation.
Anyone else got a question?
there are some people asking questions in the chat. So
Oh yeah, okay, I see. Yeah. Eddie Dem asks, when you are talking about raiding liquidity, do you mean all the stop loss set by the retail traders? So, like I say, that a area or a point of liquidity is above either recent highs or recent lows, and that point of liquidity can consist of many things. So, like retail traders are taught that obviously this area over here is a support zone, they will place their stop losses over here, and when they do that, and price comes back down. So if they put their stop loss here and they are for the buy, when price comes here, that pool of liquidity is raided. Okay. Another reason there is a liquidity pool sitting here is that we know we can also place sell stops. So when sell stops are placed, obviously when price breaks down this level, sell orders are created. So what will happen is they'll activate the sells, and then sometimes the retail traders will make money or catch the wave down. But generally, when price wicks, you'll see a rally. So you can actually see here that although it's short, this was the candle that made a rally to the upside over here, and price wicked down, taking out recent liquidity. The same can be said over here. This was a recent low, so liquidity was sitting at this point over here. And what happened when price came to that level over here? We can see that price wicked into that level and rallied up. Why did it do that? Well, you can imagine if retail traders have put their buy orders and their stop losses for those buy orders, they will be taken out the trade. And also, if retail traders had put a sell stop below this low because they are expecting price to break down, then those sell stops were then activated. So they were activated, and possibly if they hadn't been out the trade, it would have quickly gone 40 pips and then reversed 200 pips. So it is a game of liquidity, and it's not only the retail traders, obviously. We have institutions trading against each other, different banks buying and selling, governments selling, hedge funds selling, buying. So it is all a game of liquidity versus everyone, not only institutions versus retail traders. It is also institutions versus retail traders. And obviously, institutions have more money, so they don't take as much of a knock as retail traders do. But you can see how the game of liquidity works over here. And this happens frequently where price is raided and then you are activated into your trade or your stop loss is hit and price reverses against you because you are trading retail concepts. Next question. For EU, how can we tell if price will test the 4-hour order block? I ask because there is a fair value gap below the 4-hour order block. Could price close that FVG without testing the order block? There is also a 50 IPL close to the FVG. So I think I did mention that on EU. We did look at that area of price just now. So if we look on the 4-hour, like you say, there is a fair value gap sitting over here, and your broker might have different price, but yeah, generally there's a fair value gap over here, and it is likely that it could even just test the wick of this order block over here. And like you said, that there was a 500 IPL sitting over here. So currently price is trading below this 500 IPL, but price, like I said, could trade into here and then reject down like we hope it should, because it's filling a void in liquidity with this fair value gap. And obviously we have this large order block on the 4-hour that was created over here. And if we just zoom out, we can see that there is another order block over here. So this large green candle over here was traded through. So banks sell into green candles, which creates an order block, and this is an order block. Okay, so that again is an order block. So you could think of it like retail resistance, if you will, and that is the reason why price came in there. So you can see that this candle basically almost comes to the 50% level of this order block, and then price rejects down. So we are hoping for a similar scenario over here where price comes into either the 50% and then rejects down if it does not want to use the fair value gap. So if price continues higher from the fair value gap, our next area for selling would be the 50% of this order block over here, and we would like to see price respecting this order block, not trading into it, closing the fair value gap, and then going down. Because, like I said, there is more liquidity and reason for price to go down based on the daily time frame and the weekly time frame for price to go down than it is for price to go up. So even if price does go up, they might just wick it, and obviously there is also points of liquidity sitting above these highs over here, and price likes to tap into those points of liquidity, just like there was a point of liquidity sitting over here. Price wicked into that liquidity, touching this order block. There was also a fair value gap sitting above that point of liquidity over here. So if we look closer, this was a fair value gap right there. Price wicked into that fair value gap, also taking out this point of liquidity sitting over there, and also we had a bearish order block. So you can see how price reacts from something like that when it raids liquidity. But right now, more reason for price to go down based on what's happening on the daily and the weekly chart than it is for price to go up. But if it were to go up, well, we could expect a raid on that liquidity and then for price to go down if it does not want to respect this order block and this fair value gap over here. That is an unlikely scenario, but obviously I'm not a market maker, but it is potentially possible to happen. We need to wait for price action to give us a reason to sell from the fair value gap or this bearish order block over here. So we would want to see price respecting the order block, and also we have an institutional price level I said here of 800. So we wouldn't want to see price closing above these levels over here. We would want to see price closing inside of those levels and then price continuing down from those levels, because we have an order block, we have an order block on the daily, and we have a fair value gap. So there's more reason to sell than for price to go up over here. Okay, but let's just look at it from another perspective, that price recently bounced off of this order block over here. So this big move to the downside, these 2 candles over here creates ourselves an order block. That is a large order block, and you can see price rallied up and broke above. Okay, and you can see if I drag that across there, price is trading inside of this order block. So that is on the 4-hour, you can see, or sorry, no, this is a daily, that is an order block over there. Price moved to the upside over there. Okay, so there is more selling pressure than there is buying pressure right now. So we are trading inside of a range right now, as you can see, price going up, price going down, price going up, price going down. So they are basically drawing liquidity before they make their next big move. So the same can be said when this scenario at the bottom here happened. They were creating liquidity, creating the retail traders' supports and resistances and creating and collecting orders. And obviously, at some point, they need to make a move, and that is the move. So the same can be said when price accumulates orders like it is now, we will expect a move. So the move we should expect is a sell based on the order blocks from the daily and also the weekly, because price has not yet closed above this weekly order block over here. So there's a bearish weekly order block, and we can see, like I said, that there is an imbalance of price. Okay, so next question is, how can we identify the trend? Sometimes it's confusing. Kasun asked that question. Well, using the institutional order flow strategy, I guess, is your best way of following a trend. So if you haven't watched those videos, I suggest you do. It's on YouTube. That will explain precisely how to follow the trend, what is happening on the daily, the weekly, the 4 hour. It teaches you everything that we cover in these Zoom sessions. Kasun, are you here? Do you have a microphone? Anyone else got any questions?
Oh, Darren, sorry. Can we get the gold, please?
Gold, sure.
Okay. Finish.
What time frame you want to look at?
Okay, I just want to look in 1 hour.
Okay. So here was the NFP news. Okay, so call it news
Yeah.
if you want. I don't call it that. I just say an increased volatility of what price was going to do regardless of the news. So all that the NFP did was just increase the time it's going to take to get to this point in price. So what I mean by that is, instead of price coming down to this level in, say, uh, 3 candles, it just took 1 candle. If you look on the 4 hour chart of basically where price came into, there is this bullish order block over here, and you can see that basically price tapped the 50% level of this order block right here to the pip almost. So this order block to the 50% was tapped, and then price bounced. Okay, and if we look at the daily time frame, so this order block here also exists on the daily time frame, and price has not closed below this order block on the daily time frame. So if I just make this blue and we zoom in over here, so this is a daily order block sitting over here. So this black candle or bearish candle was traded through, and we can see that on the 50% over right there, price bounced off of, not even bodies were closed below. So again, on the 4 hour, we can see that price is not random, and it came to a level of 50% and then bounced. And we can also see that this void was created on the 4 hour. So this fair value gap or liquidity void, if you will, has been closed by half now. So here's the halfway point of that gap, and then price start to accumulate before the close. So price was not random during the NFP. It came, why did it come here? Well, there was an order block over here, and price tapped the 4 hour 50% level of this order block and bounced at that zone.
Okay.
Right.
Sorry, I know we don't use this.
Yeah.
I know we don't use this term, but if you go, this is H4, right?
This is H4, yeah.
Okay. Okay. That is in the call. Can you say this is about to form what the usual traders call a head and shoulder pattern, or you know,
Head and shoulders pattern, where with this move over here. So we have this move here, and then we have this move here. Like this is what you're talking about.
exactly?
Like that.
Yeah.
Call it what you will. I don't look for those patterns, but if that's what you see, then sure, you can trade something like that. But if I was to sell, I would look at selling once this gap is closed. I don't care about patterns on the chart or M formations or letters of the alphabet. I trade order blocks and order flow and institutional concepts. So if you see a head and shoulders and that's why you want to sell, then you can do that. I'm not going to stop you, but that's not something I teach. And if it works for you, then you can take that trade. But if you were to sell, I would only sell at the level over here on this gap close, on this fair value gap. But based on the momentum of the daily chart and this order block over here being respected, that price is currently quite um, ranging right now. So you can see here that price rallied from this order block and price traded through this order block on the daily market, daily time frame. So price is going to range now, because when this kind of scenario happens, we want to see a blast off move, whether it's to the upside or the downside. But based on the fact now, if I mark up this chart, you'll see two order blocks here. So a bearish scenario and a bullish scenario, but you need to go and look at your higher time frames. And you can see here, so from this order block, this big, large weekly order block on gold, price has not come near this order block. And even at the 50% of this order block right there, price bounced from the 50% of this order block and made price completely bullish. But if we look on the daily chart, so let's just clean this up, we can see that if we zoom in here, there is a big imbalance of price over here for gold over here. So this is imbalance of price, okay? So that's not to say that this is going to be filled. It could be filled next year, next week, next month. It's not to say. We need to follow what price is telling us. So right now, we are trading inside of this daily bullish order block and inside of this bearish order block over here for the daily chart. But if we go down to the 4-hour chart, we can see how price bounced off of this bullish order block over here and this bearish order block over here. So there was big orders to the upside and big orders to the downside. So the same can be said when price gets to this fair value gap over here. We want to see a momentum or willingness to go down. Okay, so you don't want to see price now start closing above this level, and then obviously we have this order block sitting over here. And obviously, if price breaks this order block, well, then it's going to obviously just continue upwards. So if you look at the monthly chart of gold, it has just been completely upwards for quite some time. And on the monthly, you can see that there is a large grouping of orders over here for the monthly chart. So this is a monthly chart on gold over here. And if we zoom in here, this is also a bearish order block over here. But we can see that we are now trading into the 50% level of this large order block over here. And also we have surpassed the 50% of this order block over here. So we can see that even when we past the 50% of this larger order block, price still rejected a little bit, but still closed above. Closed above. Now it's again 50% of this order block has closed above the monthly chart. They are mitigating their orders. What does that mean? They are mitigating orders. So their sells that they had at this position are being exchanged for buys. They are mitigating their orders and exchanging them for the opposite. They are mitigating their orders. So it is very likely that we will continue to see gold based on a monthly time frame. Well, obviously there will be retracements and whatever. So whether we see a retracement, but the overall momentum of gold is just to continue upwards, because we also have, like I said, the quarterly third quarter, July, which brings in seasonal tendencies, meaning that seasonally trends change, more money is given to institutions for investment and countries and governments. So it is likely that store of value for gold and commodities will be on the increase. So regardless of how strong the dollar is, we will want to see a bullish scenario on a long-term basis for gold. And if we drop down to the weekly, well, there's also still reason for price to come down to certain levels like we see here. There's a gap in price over here, a large liquidity void, and we could see a bounce from these types of zones if price wants to retrace downwards. But if you want to look for a sell on Monday, then this order block is where you would want to look for sells. And if you look on the 1 hour time frame, you can zoom in even further. There is another fair value gap in price. So this session is going to end now. But that is where you would want to look for sells from these zones over here, and you could possibly catch maybe 100 or 200 pips based on these small short moves. Just this move on Friday was 120 pips, so gold is very pipful, and these are the kinds of areas you would want to look to sell, whether it's short term or long term. These gaps or fair value gaps in price is where you would look for sells in the gold areas. These gaps.
Okay.